Welcome to the Dividend Talk podcast, episode 201. 3 European companies with high return on invested capital. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom and I'm joined with my co-host European DGI. If you want to learn more about us, please visit europeandgi.com where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ. You're back after a long holiday, or well, a short holiday. So how are you doing?
Well, I've been better, but having a small cold. But other than that, I'm quite okay. It's been a really good time. Just for people that are wondering, where was I? I went to the Le Mans 24-hour race. So yeah, that was awesome. I'm not interested so much in cars myself, but I learned last year what it is to go to a race, and it's really a festival for petrol heads. And I must confess, I really like it. I really enjoy it. It was from Poland, it's quite a long distance to get there, but it was worth it. It was a good experience. One on the bucket list ticked off again. How are you doing?
Good. Who won that then? I don't.
Ferrari. So
Ferrari.
people, congratulations if you own the stock race. They won. It was a pity actually because Kubica was in the not in the factory team but the satellite team.
Yeah,
they were good, but he made a stupid crash that put the whole game race into safety car, and then afterward, now they get a 30-second penalty, and after that their car got broken. So some reliability issues, but they could have won. And then the Dutch guy, Nick de Vries, was second with Toyota. But it was nice because I think there were like 9 factory teams or something like that. It's the first time that there were so many teams, and there was a lot of competition. So it was really Porsche, Ferrari, and Toyota fighting for the top spot, and it could have been anyone that day.
Nice. Everybody loves when a Ferrari wins. Just let's hope they bring that to Formula One at some stage because they struggle over there. But maybe let's talk about the news of the week, because let's start with the Euros. I know I'm getting a lot of stick online because Ireland are not in the Euros, and I'm fully aware of how rubbish our football nation is. But the Netherlands are in there. The atmosphere is incredible, by the way. I'm watching all the videos of the Dutch fans. But how do you feel about these English referees? You're starting to feel our pain.
So you're probably referring to the goal that got was not given. I mean, it was dubious. You could have you could have counted it. You could have not counted it if you think about it neutrally. English referees for me are a little bit awkward.
Rubbish.
No, not rubbish, because they play in the highest league and they allow a lot in the Premier League. Yeah, sometimes you see people kicking others and they just say, "Hey, continue. Let's play." And then you're watching in the Euros and they're like pussies. Yeah. So I don't understand it sometimes, because I like the thing that they always you say, "Come on, this is a game for men." Yeah.
Yeah.
But then when they go into Europe, maybe they have to adjust to the FIFA rules. I don't know. But then they're much stricter and whistling for everything. So I just don't get it. But come on, you can't blame a referee. There are like 22 others on the pitch there. And, you shouldn't depend on the referee, in my opinion, to win or lose. You should just play better and score more goals. Let's talk about, if you really want to go down to it, to someone like Memphis Depay, who was just really not good. I don't know why he's playing there. So yeah. It's this is the thing what we also see with management in companies, right? He wants to take every free kick, even if he is playing a bad game. He wants to make all the important passes. He's playing really rubbish. I mean, this is sometimes the same we see with CEOs. Yeah, why don't you let others who are having a better form do the important stuff, right?
Yes.
It is just like what we always say, like opportunistic management, ego, wanting to show off, being more a celebrity than anything else. You see that as in management as well, and for me, those are always red flags, and you see it now at the highest stage.
Yeah. Memphis always baffled me as a player, but I'm happy Cody Gakpo's doing well, and also Van Dijk looks to be a little bit back to where he was a couple of years ago. So yeah, I'm rooting for the Dutch. I have to say they're my favorite team this time.
Yeah, nice. Thanks. I was actually rooting for the English team, but I think somehow they are not playing well together, because individually they have the best team probably behind France and Spain.
Yeah, but I won't get into it. But I just don't understand why managers pick players and play them out of position. It doesn't make sense.
Well, I didn't talk to the Dutch coach as well. Yeah.
But let's move on to more finance related matters, and we got a question from Joris in relation to NN Group, which are going into banking, and I'm curious to hear your thoughts on this, because you're now part of the Banker Club.
Oh boy.
When are you selling? That's what I want to know.
I need to start thinking about this. This is for me kind of a red flag. Why I'm saying that, once they really become a digital bank, right? So the idea is they really want to become like a digital native bank, offering probably an app with banking services and such. But the fun fact is, they have been spun off from ING in the aftermath of the great financial crisis from 2008. I think it was in 2014, because ING was in big trouble. And now Nationale-Nederlanden wants to, after the spin-off, join the banking sector again. For me, this feels really like diversification. I mean, I also wonder, like, what is the financial authority's role in here, because they want more competition, because the saving rates are really low on Dutch banks. It's criminal, yeah. So that they are getting, let's say, 4 or 5% from the European Union, and they still only pay 1 or 1.5% to the savings rate. So there's something going on there. But remember that when I always get the question about which one I prefer, ASR or NN, I always said ASR, because they have more stable management, more solid, more grounded, and Nationale-Nederlanden sounds a bit more aggressive. And I think we just spoke about Memphis Depay and the connection to management. I see a similarity here. So I think, like, as an insurer, NN is very solid, but the risk here is that management just doesn't want to accept that they are just a boring company, giving a nice shareholder return. And if they want to go into banking, they're becoming a systematic risk to the economy, which comes with tougher regulation, which also comes probably with a lot of shady stuff that they will have to do, because you incentivize people to start, on the back of the customers, try to gain an extra percentage yield, which for them, with the leverage, is huge money. So I would prefer them to stay away from all of this stuff. They don't need it. They can just grow nicely as an insurer. So having said all of this, I'm not pulling the plug straight away, but them becoming a bank, I would like to see, like, really what their plans are. If they are just like in the surroundings, kind of playing a little bit with it, it's like Pepsi going into gaming one of those days, right? They want to have a Pepsi game. You know that this diversification. So, but if this really becomes a risk to the general assets of the company, to the balance sheet of the company, then I'm out, and I have no issue redeploying this money into ASR as soon as possible. Then,
you probably hit the nail on the head. There is a lot of talk in Europe about increasing competition. So maybe there's just some incentives that we don't know, or there's somebody pushing them to maybe go into this role, given that their history comes from a bank as well. So, I mean, they will have some experience in it.
Yeah, but diversification, that's how it sounds to me.
Nice one. Hey, I think a lot of people were interested on your thoughts on that, and
Yeah, I'm not happy with it. Why can't management just accept that they run a boring business? Why do they need to always find high growth somewhere? Just accept it. They're giving a nice 6-7% dividend yield plus some buybacks. That's already like an 8-9% shareholder yield plus some capital appreciation over time. We're talking easily about the 10% to 15% annually of total shareholder return. What's wrong with that? Yeah, why the additional risks? We know that the banks go in ebb and flows. The dividends are not sustainable typically with banks. So why is this needed? Can't they just accept boredom? And it makes you also wonder about the board of directors, why they don't select people that accept running a boring company. I really envision these kinds of 30, 40, 50-year-old bankers going for a drink on Friday evening, sitting there together or standing there together and with their fat bonuses and saying like, you know what we should do? Look at the banks, we can beat them. We can beat them. This is how I really envision this. Yeah. And I would like the banker to go home on Friday, come home, have a conversation with the wife, hug the kids and spend time with their family and think like, I did my job 9 to 5. It's maybe not the most exciting business, but it pays my bills quite handsomely, and let's spend the weekend with the family. Yeah, that's what I would like to see. Yeah, not the other kind of banker.
Yeah, but you know how it is in Ireland. At least bankers get juicy bonuses, so they make a lot more cash. So it's maybe not about the shareholder. Maybe they just see there's extra bonuses here to be made. So.
But that's why I like ASR. When you listen to the CEO, he could be a priest. I love it.
That's a quote I'm going to definitely use again. You listen to the CEO, he could be a priest.
Yeah, that's ASR. Good. Hey, what about return on invested capital? Tell me more about it, Derek.
Yeah. Today we're going to pick European companies. I suppose it triggered my thoughts. I decided to go back and start reading the Berkshire Hathaway shareholder letters. They're always something interesting to read on a summer's afternoon. And there was one in the 1992 shareholder letter, and it had said, leaving the question of price aside, the best business to own is the one that can employ large amounts of incremental capital over an extended period at very high rates of return. And that got me leading to return on invested capital, and it's something that we've never really spoke about on the show. And you see it turn around a lot, especially on social media. So I thought, hey, why not take the time to explain a little bit what it is and pick 3 European companies. We see a lot of US companies out there that generate these high returns. So I might pass it over to you, being the more financial astute colleague here. But what is return on invested capital, and why do you think it's important for investors?
Well, yeah, maybe I can start talking a little bit about why it's important and what it is. So, yes. But in simple language, effectively, if you invest €100, you want to get more money out of it, and you want it to become, let's say, after a year, €110. Yeah, so this €10 is your return on your invested capital. It's really simple. So what a company does, they invest also a lot. Let's say with their capex and such. So on this capex, you want to see a return. Yeah, and if you go, I mean, there are different formulas for a return on invested capital, but it's for instance like your long-term, liabilities plus your equity and divided by divided by the income you're making, as an example. Yeah. So, and there are many adjustments to this as well. So, but this is effectively what the company has invested and is investing in the business, and the return is generating. And the theory is like that look, if a company generates a low return on invested capital, then why invest in it? Yeah, because for instance, there's opportunity cost to it. If your company is making less than 10% return on invested capital, well, then the company might actually be better off just giving the money back to the shareholders in the form of dividends, whatever it may be, because then we as shareholders can deploy that money to a company that generates a higher return on invested capital. Yeah. So this is typically how you look at it from a capital allocation point of view. And this is also one of the reasons why many companies start paying dividends. Yeah. They say like, guys, we can't generate the return anymore for you. We are maybe at that stability level. So, hey, we're going to distribute you to this in the form of dividends so that you can spend that money elsewhere. Yeah, and generate a higher return on invested capital. It's really normal when a company goes through the life cycle. Now, then you have, of course, also return on equity. Return on equity, you really look at the equity part of the balance sheet. The equity part of the balance sheet is what we as shareholders own, because the other part of the balance sheet is the debt, yeah, and which is also included in the return on invested capital. So if you go to Buffett, I think he writes even more over time about return on equity as such, because that's really the return that you're making.
Yeah.
And so, then, yeah.
Yeah, I was going to say, so it just kind of sounds to me then that it's in simple terms, it's like an investor. You want to follow investors that don't have to invest a whole lot but make higher returns, and that's
yeah, you need to think about it at your work. When you invest in new equipment, right, you probably make a business case and you want it to earn something. For instance, your processing costs should go reduced by 20 or 25%, right?
Yeah.
Because why otherwise would you invest in it? This is the same as and actually this contributes, because that's probably a capex that you're investing there. This contributes to the return on invested capital numbers of your company. But there are also things that are maybe not to lower the cost, but to increase revenue. Yeah, because maybe you want to get a higher throughput, or maybe you want to increase sales by entering a new market. Yeah. All of this leads to your return on invested capital.
So you mentioned about calculating it, and you kind of briefly went over it, but do you want to just talk a little bit about what that is? I mean, there's two main elements that you mentioned: your operating profit or your income, and then your debt and cost of capital.
Yeah, but that's really just it. I mean, if I would advise people just to go to Google or to Investopedia. That's where you quickly can see it. But it's indeed your NOPAT, let's say your after-tax net operating profit, divided by the sum of debt and equity. But again, with ROIC, there are so many versions of it, but this is the most simple version, because, for instance, often people take out the short-term cash as an example here, or the short-term liabilities. So it really depends on the formula that you want to use, and all have their advantages. But I think that goes already a little bit more in a complex matter. I would say in general, sticking to the after-tax net operating profit divided by debt and equity is a good one. It's a simple one. But for instance, we use with our dividend safety scores that we do for the newsletter, for the premium service, we use actually return on capital employed, because it's a little bit easier to calculate and to compare across all the companies. So that's why we use that one. And capital employed is also, again, like what is the capital that's working for you, yeah. And it's even a more simple formula. So what is just in general important with this is to think about, generally as a rule of thumb, I would say always look for companies with a return on invested capital of higher than 10%, because otherwise you could better probably invest your money elsewhere. Yeah. However, there's another component to it, and that's the weighted average cost of capital.
Oh, okay.
So money costs money. That's how you need to think about it. So if you invest €100, there's this kind of time value of money. This €100 will be, from a purchasing power point of view, maybe by next year only worth €92. Yeah. So that's why cost of capital is important. And cost of capital is a mixture of the debt that you're having, let's say you pay a 5% interest rate on your debt on that, and let's say your €100 is financed 50% by debt. Yeah, so let's say 5% of that. But the other 50% might be the equity that you're having, the cash that you're taking from the shareholders. But shareholders have an expectation in return. They may have an expectation that you turn this into 15% return. Yeah. So that's where the term weighted average comes from, that you need to blend those 5% that you owe to the bank and the 15% that you owe to the shareholder together, maybe comes at, I don't know, an 8% cost of capital. Now, why is this important? If you're not generating a return of invested capital higher than your weighted average cost of capital, you are not making any money for the company. You're effectively losing money, which may not be visible on the balance sheet, but that's why it is important to look at. That's also why they call this the EVA, and where I forgot what the E stands for, but it's all about like the value generation you're creating. That's a formula, which effectively is the return on invested capital minus the weighted average cost of capital. And here I would say you always want to have a difference of more than 2%. Otherwise, you're trading on a very thin margin here with your investments.
Yeah, it gets really complicated with that because you have to try and calculate the weighted average cost of capital. Is there an easy way of getting that?
Well, yeah, you can Google for it. Some companies put it in the annual reports, but it is a complicated, I said, calculation, because you would need to look at the interest paid in that given year, looking at the debt that you have, you get kind of the percentage then of what the actual interest rate is that the company pays. But then you also need to understand, I think it's the capital. It's like CAPM. I forgot the acronym exactly, but it's pricing model, capital asset pricing model or something like that. Which, and in this way it gets complicated, because it's really then a mixture of what is the historical return of the stock price and everything, and you start to all blend it in. So it's difficult. But what I would say is, like, look at the report. Annual report. You typically see what for instance the company itself uses for the cost of capital when it talks about the businesses that it owns and such. But sometimes you also just know what it kind of is for a company. Like, often it's around 8 or 9% for a company. And the tricky thing is the companies like Microsoft, they actually have a higher cost of capital than for instance an Ahold Delhaize. And this is very interesting, because when you start looking at it, this looks very confusing. But it's if you remember that one of it is shareholder expectation in the return, well, maybe people expect a 20% return in share price, let's say, on Microsoft, and that creates a higher cost of capital for them, because there's an expectation to deliver on that. Yeah. So, but generally speaking, usually companies have around, depending on the interest rate environment, let's say between 6 and 10% in cost of capital.
So I think overall, then, it sounds like ROIC is a good way of finding compounders. They can generate more cash flow, and when that's increasing, then obviously there's more scope then to increase dividends.
Yeah, because if a company is making 20% on the money they have invested, yeah, that's of course a lot of money. There are some risks here, because sometimes you see those numbers, but it may be that the company is underinvesting and just taking all the profit that it can get. So you should never look at those metrics in isolation. It's the same with your house. Imagine that you're renting out to your tenants, and you're making, let's say, €1,000 a month on the rent. Yeah. But you're not investing, you're not reserving money for a roof repairment, and then suddenly your house starts collapsing, and people are not willing to pay €1,000 anymore for it, but maybe €500. So while ROIC is important, you need to really look at it also in context here, Derek, because you may look a bit too short-sighted at it.
Yeah. Okay, I think that was a nice introduction. Is there anything else then investors should know about this, or will we move on to our 3 companies?
No, I think like, just generally, I think it's one of those 10 things you can look at. I would not solely go into this, because if you look on social media, it seems to be the single most important metric.
Yeah.
it is an important one historically, but you really need to understand it's a complicated one, because what I mentioned, you can calculate this one in many ways, and a lot is driven by how the business operates and how you should calculate it. Also, companies are reporting these numbers, but often they have a lot of adjustments in there. So don't stare blindly on this. Don't trust all the numbers you see. And if you find like, okay, actually this is on the too hard pile, that's okay.
Yeah.
That's okay. There are many other metrics that are good to look at. Let's, for instance, say the debt to equity ratio.
Yeah. And of course, not every sector is equal. So
Yeah.
you can't expect each sector to have double-digit return on invested capital either, because it's just not.
Yeah, exactly. No, let's go on. So what are those companies then in Europe that for you are a nice example of what you call then compounders? And we've been looking here, of course, at companies that grow their dividends, right?
Yeah,
of course. DividendTalk.
Of course, it's dividend growth investors. And I think the first one, look, we're going to stick with the Dutch team. We spoke a lot about Dutch companies and Dutch football team. So I think it's only right we start with ASML. We all know that they are like the number one semiconductor supplier of these lithography machines, and their return on invested capital. And I took this, I didn't calculate this out myself. I took this from a website called Stock Analysis, but they have a return on invested capital of 37.54%. And we can see that, can't we, in our recent dividend history? Like, they've had double-digit dividend increases over the last couple of years.
Yeah, for me, it's a clear example of a company with a high return on invested capital. And the question is then why? Yeah, why they have that? And here you come really again to what the number really means. Effectively, they are running a monopoly. So they have pricing power with that. What I love that the CEO mentioned, like, we don't want to just raise the prices absurdly high, because then we will give an incentive to our customers to start investing elsewhere to buy machines. So they're really trying to balance this out. But it just means like they can every euro they invest, they are making 37 cents. Yeah, which is really, really high. And yeah, they have been able to do this consistently over many years now. So yeah, that's why it's also a high grower and is able therefore also to grow the dividend. Yeah, because if you remember, ROIC, return is the net operating profit. Yeah.
Yeah.
So yeah, it's for me a really good example. And the reason here is mostly because it's a monopoly and it gives them pricing power. High entries to barriers to entry this market as well. It's not like when you dismantle this machine and copy each individual part and pull it back together that you have a running machine. Now it's such a high-end industry. Just the glass they already use from Carl Zeiss, the lenses, it's I mean, that's so hard to replicate. Yeah. So but again, this is what the ROIC allows them to do because of the industry they operate in and the market position they have.
Yeah. And it's interesting you mentioned pricing power and brand power, because I think that's going to be the common theme that we see throughout these three companies. And you look at the second one we have, which is Moet Hennessy, Louis Vuitton, LVMH. They are a luxury goods provider. What have they got? Huge pricing power. I mean, their brand is known all over the world, and they can nearly charge what they want. And that enables them to drive huge profitability. Their margins are high on the products that they make.
So, 16.9% actually is quite low compared to ASML as an example, right? But again, if you do this year after year after year after year, this matters, right? There's a big difference between 10% and 17% return on invested capital. If you would do this for your own dividend growth rates, you would exchange 10% for 17%. That's the difference between many, many millions or just a few millions, right? And I think that's important to mention, that those numbers, while there's a lot of sensitivity in it, because it depends in the end on the profit of the year, what number you see here. But if you zoom out and look over the years, yeah, then this is what makes them compound. And yeah, to your point, Louis Vuitton has this exclusivity. They're an excellent company in branding, and creating scarcity. And for me, it's another of such nice company with a very high return on invested capital. And yeah, that begs me also the question, and I'm curious to hear your thoughts about that. Does a high ROIC also justify a higher multiple, in your opinion, or a higher valuation? Let's call it like that.
It probably does, because you're expecting everything to grow at a higher rate than, say, you own utilities that are growing at 1 or 2%. So you're expecting more growth. I'm expecting the free cash flow to grow at a higher rate than I would if the return was lower. And I place a lot of weight on free cash flow, because I think that's where the dividends come from, and that gives it the safety. And if that's growing at a high rate, I'm expecting the dividends to grow at a high rate. And I'm prepared to pay a little bit extra, not over the top, but I would definitely be willing to pay a higher multiple for those types of companies, because they can generate higher returns for me.
So what you're actually saying is, like, because we always use the discounted cash flow model or a lot, right? What you're saying, like, I just have higher growth assumptions of the free cash flow.
Yes.
And therefore the share price that comes out of it has it already embedded, the higher growth. And usually when you then look at the multiple, you may see a multiple of 25 or 30, but then you feel like, yeah, that's justified because this earnings or this free cash flow will just grow into this. And if you would look 10 years from or 5 years from now, this multiple maybe on the current share price, let's say 15 or something like that, because it grows into it, right?
Yeah. And I think Microsoft would be a good example of that.
Yeah, exactly. But then are you saying that it's not so much then when it comes to valuation for you about the ROIC, but more like for the free cash flow growth assumptions, and the ROIC, if you look at it, or the return on capital employed, is a good indicator whether you are using the right numbers in your model?
Exactly. Yeah. So it's more like a tool to point you in the direction to help you with your assumptions. But like for me, valuation is the sum of future cash flows. And this is just a little tool to help you. Are my growth rates too unrealistic, or are they justified based on what the company have done in the past?
So and then maybe I know we will still go to a third company, but how do you assess whether this high return on invested capital is sustainable?
Usually in what we just mentioned is strong brand. Most of these companies have a strong brand, or like they're the number one brand in their area or sector. You look at ASML, you look at LVMH, you probably put Microsoft, Nike, all of them have strong branding power. That gives them pricing power, and usually they're not once-off trends. They're usually sustainable over 10 years. So I try and look at a 10-year like period, and over the next 10 years, do I think anything is going to knock LVMH off? No, I wouldn't say so. So they have competitors, but they will always have that strong brand portfolio. So,
but that's interesting that you say it. And how then do you look at something like Texas Instruments?
Texas Instruments still have that brand, but I wouldn't put them into the same category as, say, ASML, because they don't have the same type of monopoly. They own certain chip markets, but I think they are more easy to replicate and so I know, say, from my work as automation engineer, that if I'm looking for a chip, you start looking for quality first, right? But knowing your budget starts to run down, you have to make certain decisions. Sometimes you might go, okay, I can get this chip from a different company that does the same job as a Texas Instrument one, and you go there. Whereas with someone like ASML, you can't really do that. You have to go with their products. So again, with Texas Instruments, they don't have the same brand strength, in my opinion, as ASML.
Why I'm asking is, for me, Texas Instruments is a classical example of a company with very high return on invested capital and such over the years. But also a company that was underinvesting and now has to do a 4 or 5 year cash flow investment to keep up with the market, which, of course, during those 5 years probably will lead to a lower return on invested capital than what shareholders are used to, which may suggest to them like, oh, let's better stay away. This company is not in a good situation. But that's why it's so hard for me always with these numbers. If you don't understand the story of the stock, that the company is going through an investment cycle, then you can't just look at the number. Therefore, it's really in the end again business analysis what it comes down to, right?
Yeah. I think you hit the nail on the head earlier when you said not to look at the numbers in isolation. And I think when you're analyzing a stock, what you're really trying to do, or what I try to do, is tell a story about where the stock has been and where you think where the company has been and where you think the company will go. And then based on that and the numbers around that, that's where you get your growth rate. So of course you have to understand, invest in what you know. You have to understand the business. So I'd agree with you there.
Good one. So what's the third company then on European mainland?
I left this to last because the ROIC is off the chart, and I know that you have analyzed this company recently, so I'm interested to hear your thoughts on why. But Novo Nordisk, we spoke about them quite a bit. They're a Danish pharmaceutical company, obviously specializing in diabetes care, and now they have this wonder drug that helps you lose weight. But the return on invested capital is close to 70%. I mean, that's a lot of dosh.
Yeah, and it's just a result of being able to maximize the revenues based on a single investment. Yeah, that's the investment in GLP-1 having a breakthrough, which puts the earnings growth on fire. Yeah, because now it's really the sales apparatus that needs to do its job, and they even have supply constraints. Yeah, so they're not even able to maximize profit from that point of view because they can't even deliver enough, although that's changing at the moment. But for me, this is an example why you actually shouldn't stare blind on the ROIC, because it's now in a very high growth curve. But this, you can't extrapolate this into the future and think that this will stay there for the next 20 years.
Yeah,
The competition is looking at this gold mine as well. Although they are definitely a first mover, having a first mover advantage, the best pipeline, the best portfolio. This is for me a classical example of where the ROIC is really a momentum.
Yeah, and you read my mind, because that was the question I was going to ask you. When you see this type of figure, like, would it not scare you a little bit, because it's not sustainable to have 70% returns over 20, 30 years into infinity?
No, it isn't. It doesn't scare me, but I'm just like, then when I see that, like, okay, what happened here? Yeah, what is going on? Because there's a story behind it, and this is, I think, here the case with Novo Nordisk. It has momentum still for a few years, with probably very high growth rates, provided that regulators don't step in to some extent, right?
Yeah.
So, and that's it. But with that, you really need to take this number also with a grain of salt over the long run. Not saying that they can't make a 20% return on invested capital, but 70% seems highly unlikely if you think about our time horizon, investment horizon, which is like at least 10 years, but preferably even 20 years. Yeah. But it's a company on fire. If people are interested to really learn more about it, what's my opinion also about, let's say, the dividend safety and the fair value, then I would recommend reading the last newsletter that we did to our premium subscribers. But yeah, I mean, I think we should be proud on all these three companies that these are European based. I mean, ASML, monopoly; Novo Nordisk, a monopoly in this disease area; and Louis Vuitton, I mean, the company together with a few of the other French dominating the luxury industry. I mean, I think we should be proud on this, and it shows that although the European Union and the local countries are not making it easy for companies to earn money compared to a more investment-friendly country like the US, there's still a lot of strength in some of the industries, and yeah, it's evidenced by the high returns on invested capital.
Yeah, I'd agree with that sentiment. I think as Europe, and we could have picked a couple more companies from Europe as well, but I think we should be incredibly proud of the companies we have over here, because globally they are quite strong. A lot of people point to America, and quite rightly, because it's a dominant market, but European powerhouses stand out, I have to say, once they get going.
Yeah, so hey, maybe to sum up this topic, right? Please don't stare blindly at all those social media tweets about compounders, companies with a high ROIC. Don't just buy them because they pop up on a list there. It is an interesting metric. Seasoned investors will say that return on invested capital or return on equity or return on capital employed is probably one of the most important metrics because it tells you more about what your future return could be if you are able to buy it at the right price. Yeah.
Yeah.
So take it like that, but it's always a story behind it. We just gave an example of Novo Nordisk where it's momentum. We gave an example of Texas Instruments that's going through an investment cycle. We gave an example of ASML, which is currently having a monopoly. Question is for how long? Yeah, and then about Louis Vuitton, which is in a very competitive industry, has a lot of pricing power. But you see also compared to Novo Nordisk and ASML, it's 17 return on invested capital versus 37 or 69. Yeah.
Yeah.
So the story is even more important behind it. And you can't escape from business analysis. You can't escape from just reading the annual report and trying to understand what's going on there.
Yeah, a nice summary. So I can tell you're hanging in there. You're hanging in there, buddy. So we'll move on to the listeners' questions, and we'll try to get this over. Your voice is starting to break. So Russ has asked us, what's the most unusual place you've ever thought about dividends?
Well, maybe it's not the thinking as such. I'm just thinking, have I ever thought about it during sex? But I can't remember that. Maybe once I when you see Durex or something that you think like, oh, I haven't invested in this one yet. But I do have this awkward stuff that when I'm just walking around, I see companies everywhere and I think like, oh, wait, hey, damn, this is a dividend company. So I was in France on the toll road, right? And I see Vinci and I felt like, Vinci, nice, yeah. So it usually comes indeed at unexpected moments, but unusual, I really can't say. I don't know.
Yeah, unusual is quite a difficult one to say, but I agree with you. When you do travel, I think as a dividend investor now, you are more open and you look at it. You look at a building, you see a sign, you're like, oh, they pay dividends, and you go on your phone straight away and check them out. So
yeah. Or you see companies or let's say products in an unexpected place somewhere that you feel like, oh, wait a second, are they also here? Yeah. So that's also what's often happening to me.
Yeah.
Like I had this with, what's the energy company from France called again with V in there? I forgot. But then I'm walking in Warsaw, and you have the sewer system. You see those covers, those metal covers.
Yeah.
And I see the French company name on there, and I felt like,
oh, Viola.
Yeah, exactly that one. And then I look at that one, I think like, oh, I didn't know they are also having their products installed in Warsaw as an example. Yeah, for me this is really interesting. And then the funny thing is, if you're walking with someone, then you think, okay, should I be the geek now, start talking about this, or should it be just my inner joy in my brain, where I'm having a little chuckle? Yeah,
depends on who you're with.
Yeah, true.
So Tiago over at Shade Research, who's on Substack, has said he is considering beginning to invest some money in bonds with a set expiration date when I expect to use that money for a down payment on a house. Have you considered that sort of portfolio allocation? And he's also asking us the best place to buy bonds.
Yeah, definitely. Of course, this comes to my mind when I need the money. To his point, and you want to have guarantee. But honestly, I usually come back to, at least in Poland, to just making a deposit and lock my money for a year and getting a higher interest rate on it. Because, for instance, the interest rate would be 4%, but then a bond would be 5%. So then I rather have it on my bank account for simplicity. Yeah, I know I miss out on a percentage.
Yep.
But that's usually what I do. Now, he's also saying like you can find the bonds on interactive brokers. And yeah, that's where you can buy them. I think you need to really look at the long duration and everything of this. So, Jago, if you want to one time exchange some thoughts, let me know. But for me, it's just more. I'm not in the Netherlands, right? So in the Netherlands, I would you would probably have the story about bonds earlier. Now, when it comes to portfolio allocation, I think bonds play a very important role there, because it creates discussion to your to your portfolio and allows you to do some wealth protection in there as well. And the classical example is like, okay, take your age, and that should be kind of your percentage in bonds in your portfolio. So let's say 100 minus your age of 40. I have 40% in stocks and 60% in 60% in stocks and 40% in bonds. That's kind of the classical one. I'm a bit more of a risk taker here, because I have a feeling that I know better what I'm doing. So I have no bonds. But if you would talk to pension funds, that's how they typically look at it.
Nice. Martin has asked us about our thoughts on Abbott. Ticker symbol ABT.
Yeah, so my thoughts are really simple, Martin. I think it's a very high quality business. I like them more than Medtronic as an example, but I do believe that for such a stable blue chip company, I expect a bit more than a 2% yield, especially also that the last 1-2 years were not their best years. They really had less free cash flow coming in and less earnings coming in. So I don't see that reflected in the price and in the yield. So that's what I expect.
Yeah, I'm just saying thoughts. They're a solid dividend company, dividend growing company, good financials, but yield is too low for me to look at them. So
yeah,
I usually stay.
And we had actually, before Matt, we forgot about one question. It's from Jos Brokel dude. And he is asking, does the current high interest rate affect dividend shares? And do you think lowering interest rates will also affect the share price? Yes and yes, is the question, Jos. It's really simple. Many analysts, I said, they priced this in because if you remember earlier in the show where I was talking about the weighted average capital, cost of capital. So if the interest rate increases, then the cost of capital becomes more, which means if you would do a valuation assessment, you need to take this into account, and therefore the share price becomes lower in a higher interest rate environment, because companies are, they are faced with the higher cost of capital, while usually on the upside they can't easily increase the earnings. Hence, there's less left than bottom line, hence why it justifies a lower share price, hence why the yield is typically higher. So I hope this helps.
Claudius then has asked us about beverage companies. So you've got the likes of Diageo, Pernod Ricard, Davide, Campari, Milano. They're all relatively weak, losing share price nearly daily. They're dropping. And he's wondering, is the growing Muslim community and Chinese trading barriers a real long-term threat, or do we have opportunities right now? I'm not too sure how much of that is down to this growing Muslim community, if I'm honest. I think it's more to do with people's health and this, like, alcohol is unhealthy, and we've all got this like help us. And I'm not sure. I don't know what your thoughts are, but I don't think that a growing Muslim community is contributing.
No, I don't have that feeling either. Generally, Jago has been already struggling for a few years. Yeah, that's just not been reflected in share price because, I don't know why shareholders want to pay such a premium for it, right? It was depending a lot on the Chinese market and the growth there. It's clear that the Chinese consumer was much weaker over the last 2-3 years. We see that also in other Chinese stocks and companies struggling there. I do believe that geopolitics may play a bit of a role, but Diageo was also, for instance, having poor sales in LATAM, in Latin America. I think more what is struggling here is that these companies have been, over the last 20 years, benefiting from the wave of globalization. In other words, they have been entering many, many new markets that were earlier not so accessible in the 80s and the 90s. And maybe we're at this stage, and you see this with other companies as well, where it becomes saturated. Yeah. So the question is then, what's next? Is this secular growth trend finishing now? Are we in the last innings? And then the question is like, what will be the next growth trend for them? Yeah, that's how I look more at these stocks. But these are generally high quality businesses. Yeah, so let's not be let's be clear about that. They have high quality brands and everything. And then the question is like, is a secular downtrend that the youth is maybe drinking less than what our generation is grown up with, as an example. And these are questions I think that are mattering. But the fact that Claudius is thinking about it like this is already really good, because it means he's really trying to understand like, what is this? Yeah? What is the underlying trend below it? And he might be right. You and I just have a slightly different opinion about where this weakness may come from.
Yeah, exactly. It could be dead on. For the record, I still think Diageo is trading at a premium higher than I'd be willing to pay for it at the moment. But it's getting close to
interesting valuation again,
really
right?
Interesting valuation. But you're right. These trends, and it's funny you touch on younger people and their drinking habits, because Ireland is known for its drinking culture, as you well know, and we can start to see that in our younger generation. They're not drinking as much, they're not drinking as early, and it's shifting. And if it's still not in Ireland, it's probably already that way in America and most of Europe. So it's an interesting thought. Richard Taylor has asked us about Clearway Energy. They have a 6.5% dividend yield, and the dividend growth rate has been strong over the last 3, 5, and 10 years, and it is in the renewable energy market. Have you ever looked at it? I haven't, but the fact that it's a US renewable energy company is quite interesting. I have a couple of those in Europe already, but I probably tend to stick to Europe because I understand that market a little bit better than the American market. But in terms of their dividend, they have a good history. They did cut it in 2019 during COVID, but they've been growing it at a really fast pace since. So it does look like it could be a good option if you want to get into this renewable energy space. But I have UK wind in the UK, and I don't really want to have too many companies in that sector.
Same here, exactly the same thinking here.
BTO5 has asked us about healthcare stocks. Is it the right time to consider entering these? There are plenty of beaten down companies such as Roche, Pfizer, Bristol Myers Squibb, and Sanofi. It certainly seems the way, doesn't it?
Well, I would not buy it because of looking at the price. Really not. Many of the big pharma stocks currently struggle from their pipeline and making big breakthroughs. That's why all these stocks are trading where they are today. So, I mean, you really can't escape here from looking into the pipeline. And as an example, I'm very bearish on Pfizer long term. I think Seagen acquisition, a lot of money for little cash flow and for little cash flow potential. So I think they're trading at the right price. And the question is like, long term, on which are you bullish? Here, yeah. So you need to understand the pipeline a little bit, and yeah.
And I've spoken about my struggles with that. Understanding a pipeline is no easy task. But of all of them, BMI seem to be generating so much cash flow. It doesn't seem to be bothering them at the moment.
Yeah. So it's the question like, what do they do with this cash flow, right? They've been buying a lot lately. So, yeah.
Okay, and the last question is from Arne, and he has asked us about our thoughts on Aegis. It's a Belgian insurer.
Yeah, so Agias, I know this company. I've looked into it a few times. I know they have a high yield, but the dividend tax is quite high in Belgium, and I find just ASR and N Group just more interesting. I also find Munich RE more interesting. I mean, the good thing is we have enough choice in Europe with insurers. So if you have a good feeling about Agias, by all means, go for it. I just from an opportunity like comparison point of view, I just understand NN Group and ASR better as a former Dutch citizen. and having had policies with them. Yeah. So, but that's why I've never really dug down into areas. But I think this is where the Peter Lynch comes in, right? You buy companies that you understand, that you're a bit familiar with. That's already a good indication. Yeah.
And then the last question from Bass Erlings. What are your thoughts on covered call ETFs?
Yield chasing.
There's no such thing as a free lunch as comes to my mind when I think about covered call ETFs. I mean, you look at options, the risks are there, and just because you bundle it into an ETF doesn't mean those risks go away.
Yeah, and hey, if you want to chase yields on the short term, then this may be a perfectly valid reason. But just ask yourself, like, is this the reason why you want it? Because watch out for your capital that you put into it. In the long run, this may just decline. So then you're maybe getting a yield, but if you ever want to put your money out of it, then you may be disappointed. And secondly, the yield will also adjust to the price, because it's getting the yield from the covered calls on those prices.
Yeah, feels almost like investing in tobacco companies. You're getting yield, but the price keeps dropping.
Yeah, maybe, yeah. But hey, these serve a purpose. As long as you're aligned with that purpose and you understand the risk behind it, then by all means go for it. Yeah, but that's, if you ask me what are my thoughts, the first thought comes in mind is yield chasing.
Yeah. Awesome. Well, that was the last question. So thanks to all our community for sending in those. Thank you, European DJ. I know you're a little bit under the weather. You've done well to last an hour here. So
thank you.
And we will talk to our listeners next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.